Imagine this scenario. It's February 2022, and you're a truck driver in Ottawa. For 3 weeks, you've been participating in a peaceful protest. Your bank account holds $47,000. Your life savings, your mortgage fund, everything. One morning, you check your phone and see a zero balance. Not overdrawn, not frozen by a court order, no warning, just gone. Your offense? The government deemed your political stance inconvenient. 2 years later, a Canadian court ruled this action unreasonable and unconstitutional. But that ruling came after your bills defaulted, your credit was ruined, and the damage was already done. The clear lesson: digital money can disappear with a single keystroke. This isn't a hypothetical story. This happened in Canada in February 2022, and it serves as a blueprint for what 134 countries are now developing. What truly concerns me is that we are at a critical juncture regarding the future of money, yet most people are unaware of this divergence. On one side, central banks are advancing what they term digital currency innovation. Concurrently, they are constructing the most extensive financial surveillance system in human history. It's the same technology, but with different programming. The decisions made in the next 36 months will determine whether you can still buy basic necessities without authorization by 2030. 3 distinct systems offer 3 fundamentally different answers to the question of who controls your money. Central bank digital currencies, CBDCs, where governments dictate every transaction; cryptocurrencies like Bitcoin, where decentralized code replaces central authority; and physical gold, which you possess and which cannot be programmed, frozen, or tracked by anyone. By the end of this discussion, you will fully grasp the concept of programmable money, understand why the general manager of the Bank for International Settlements stated that CBDCs grant central banks absolute control, and learn why 98.5% of Nigerians refuse to use their government's digital currency, even amidst cash shortage-induced riots. Allow me to illustrate the architecture of this trap before it fully closes. The first point is an admission that they are not even trying to conceal. In October 2020, during an IMF event, Augustine Carstens, general manager of the Bank for International Settlements, the central bank for central banks, spoke on camera. He stated, "With cash, we don't know who is using a $100 bill today. A key difference with the CBDC is the central bank will have absolute control on the rules and regulations that will determine the use of that expression of central bank liability. And also, we will have the technology to enforce that. Not influence, not regulate, absolute control." Consider this: the individual coordinating global central bank digital currency development openly declared that while cash transactions are opaque to them, CBDCs will grant them complete visibility and control over everything. This is not a conspiracy theory. It is the architect explaining the design. The stark reality is that Federal Reserve Chair Jerome Powell conveyed a similar message to Congress in 2019, indicating that a CBDC could reasonably require the Federal Reserve to maintain a continuous record of all payment data. In simpler terms, they would know when you purchased fuel, where you bought groceries, to whom you sent money, and what you spent it on. Total financial visibility and an immutable record. The second aspect is the international coordination designed to go unnoticed, Project M-Bridge. If you haven't heard of it, that's by design. It's the Bank for International Settlements cross-border CBDC platform, launched with China, Thailand, the UAE and Hong Kong, and Saudi Arabia joined in 2024. Over 30 central banks are now observing, including the European Central Bank and the Reserve Bank of India. The official narrative touts faster cross-border payments, lower transaction costs, and more efficient settlements. Here's the critical detail. In October 2024, evidence emerged that companies in Xinjiang were utilizing M-Bridge to circumvent US sanctions, with Chinese regulators explicitly instructing banks to use the platform. The BIS's response was to delegate day-to-day management to the participating central banks and withdraw direct oversight. This outlines the infrastructure for a parallel financial system, enabling transactions to bypass SWIFT, US sanctions enforcement, and the existing monetary order. It is operational, not theoretical, and not 5 years away, currently processing real value transactions. The third element involves the features being embedded directly into the money itself. China piloted a digital yuan with an expiration date, not for the wallet or the account, but for the currency itself. During COVID-19, they distributed consumption vouchers that would vanish if not spent within a specific time frame. The European Data Protection Supervisor has explicitly documented this risk. Once programmable money exists, governments can restrict spending based on category, geography, individual status, or time frames. This could mean money usable only for groceries, not fuel. Money that expires in 30 days, preventing saving. Geo-fenced money that cannot be spent outside designated zones. Or money that requires a social credit score check before a transaction is approved. What critics of gold often overlook is that this is not about enhancing monetary policy. It's about transforming money from a tool you control into an enforcement mechanism operated by the state. And once this infrastructure is built, it rarely becomes less intrusive. It only expands. Fourth, there's a cautionary tale they are attempting to suppress. Nigeria launched the e-Naira in October 2021, backed by a government mandate, central bank incentives, and a massive promotional campaign. It was positioned as a tool for financial inclusion in a nation where most transactions were cash-based. 1 year later, 98.5% of activated e-Naira wallets had never been used. Not once. 0 transactions. By late 2022, only 0.5% of Nigerians were actively using it. The total transaction volume for an entire year was 4 billion naira, equivalent to 9.3 million US dollars, in a country of over 200 million people. The central bank became desperate, imposing restrictions on cash withdrawals, aiming to force adoption by limiting supply. The public's response was not compliance, but riots. Violent protests erupted across major cities. People chose disorder over the digital currency mandated by their government. The unsettling lesson for central bankers is this: even when alternatives are made scarce, populations will endure significant disruption rather than adopt systems they distrust. Nigerians resorted to black market cash, embraced cryptocurrency despite regulatory ambiguity, and relied on informal value transfers, anything to avoid the surveilled digital system. The e-Naira remains operational, but it is effectively a dead system walking. Let me take you back to February 2022. Canadian truckers were protesting vaccine mandates in a peaceful convoy. The demonstrations lasted 3 weeks. Prime Minister Trudeau invoked the Emergencies Act, not to arrest them, but to freeze their bank accounts. There were no court orders, no due process, just administrative authority exercised instantaneously. Bank accounts were frozen, crypto wallets were frozen through exchanges, and crowdfunding platforms were shut down. Anyone who donated had their financial access severed. A Canadian appeals court later ruled these actions violated constitutional rights, explicitly calling them unreasonable. However, that ruling came after the damage had occurred, after bills defaulted, lives were disrupted, and the precedent was established. Here's the crucial point. This happened in a democratic nation with constitutional protections, leveraging existing financial infrastructure. It required coordination between the government, banks, and payment processors. It took time, and it left a paper trail. With a CBDC, that process becomes instantaneous. No coordination is needed, no bank compliance is required. The central bank directly programs the restriction into the currency. Your money simply stops working, not frozen, but rejected at the transaction level. What keeps me awake at night is this: if they could do this with the clunky existing system, what will happen when they control the money itself? While most people were focused on other headlines, something crucial was overlooked. The Biden administration orchestrated a regulatory campaign to debank the cryptocurrency industry. They termed it supervision. The House Financial Services Committee investigation labeled it a coordinated attack on the digital asset ecosystem. This wasn't achieved through legislation, but through regulatory pressure. The Federal Reserve issued supervisory letters, making crypto-related banking so burdensome that banks exited the sector. The Office of the Comptroller of the Currency, OCC, mandated pre-approval for any crypto activity. The FDIC instructed regional offices to direct banks to pause crypto services. Silvergate Bank and Signature Bank, pivotal banking infrastructure for crypto transactions, faced coordinated scrutiny until they failed. Other banks seeking to serve crypto firms found master account access systematically denied. This represents the weaponization of regulatory authority to eliminate an industry without congressional authorization. and it succeeded. Now, imagine that same authority directly embedded within programmable money. There would be no need to pressure banks. Simply program the currency to reject transactions deemed undesirable. That is the CBDC endgame. Bitcoin emerged from the 2008 financial crisis as a direct response to this very problem. Its pseudonymous creator, Satoshi Nakamoto, designed it to eliminate the need for trusted third parties. There is no central authority that can print more, no government that can freeze accounts, and no bank that can censor transactions. Here's its architecture. A distributed ledger maintained by thousands of independent computers, consensus achieved through proof of work, and a hard-coded maximum supply of 21 million coins, which cannot be changed without majority network agreement, a change participants have an economic incentive to resist as it would debase their holdings. The result is permissionless money. Anyone with internet access can join the network, send value, receive value, and hold value without needing permission from any central authority. However, what Bitcoin advocates often don't emphasize is that Bitcoin is pseudonymous, not anonymous. Every transaction is recorded on a public blockchain. Blockchain analysis companies have created advanced methods for linking digital addresses to actual identities, particularly when these addresses interact with regulated exchanges that require Know Your Customer (KYC) data. Consequently, Bitcoin is considerably more traceable than physical cash or gold. Law enforcement agencies can track financial movements across the network. However, and this is crucial, Bitcoin offers significantly stronger resistance to seizure compared to traditional bank accounts. Holdings can be stored offline, memorized as seed phrases, and concealed in ways that prevent physical censorship without coercion. For many users, this trade-off is acceptable. Pseudonymity paired with censorship resistance is preferable to complete surveillance with asset freezing capabilities. The stark reality is this: Canadian truckers who held Bitcoin in self-custody could not have their funds frozen. Conversely, those who kept their Bitcoin on exchanges where KYC data was provided saw their accounts frozen, just like conventional bank accounts. Self-custody represents the distinction between truly owning Bitcoin and merely having exposure to it. This brings us to assets that operate entirely outside digital infrastructure. Physical gold held in one's possession. Such assets require no digital record, no network, and carry no third-party risk. When Germany's Weimar currency collapsed, a few ounces of gold could purchase the most expensive house in Berlin. In 2019, when Venezuela's banking system froze deposits, trapping citizens' life savings, physical gold and US cash were the only assets that retained their value and functionality. Gold needs no electricity, no internet, and no institutional solvency. Its value stems from its material scarcity and 5,000 years of human acceptance as currency. What might seem counterintuitive is that an analysis by the Official Monetary and Financial Institutions Forum, OMFIF, concluded that central bank adoption of digital currencies might actually boost demand for physical gold. Why? Because central bank digital currencies, CBDCs, with inherent features like spending limits, negative interest rates, or programmable restrictions, create a rational incentive to move wealth into assets free of such constraints. If your government announces a digital dollar with a $3,000 holding limit per person, a concept the European Central Bank considered for the digital euro, you would have an immediate incentive to convert excess savings into assets without limits, such as gold, silver, or real estate, anything that cannot be programmed or given an expiration date. However, physical gold comes with its own drawbacks: storage costs, insurance premiums, and liquidity challenges when needing to convert it into currency for daily transactions. The transaction spreads incurred when buying and selling physical gold make it less practical for routine payments, even though it excels for long-term wealth preservation and systemic risk hedging. These costs are prohibitive for everyday use, which illustrates that the solution isn't to choose a single system, but rather to recognize that each serves different purposes. So, where are these patterns currently unfolding? Nigeria has reached stage 5. Its CBDC was launched and subsequently rejected by the populace, rendering the system effectively defunct despite being technically operational. China is in stage 4. Its advanced digital yuan is operational, with programmable features undergoing testing and documented integration with its broader social credit infrastructure. Europe is in stage 3. Preparations for the digital euro are underway, featuring privacy protections but also holding limits, and KYC requirements at the intermediary level. And then there's the elephant in the room, the United States. Executive Order 14,067, issued in March 2022 by the Biden administration, directed federal agencies to coordinate research and development for a U.S. digital dollar. In May 2024, the U.S. House of Representatives passed the CBDC Anti-Surveillance State Act, which prohibits the Federal Reserve from issuing a CBDC directly to individuals without explicit congressional authorization. Representative Tom Emmer reintroduced similar legislation in March 2025. The political battle is ongoing, and its outcome will determine whether Americans can still conduct private transactions in 5 years. Here's the harsh truth. If Project M-Bridge scales, if the digital euro launches, and if China's digital yuan becomes Asia's dominant payment rail, the US will face immense pressure to introduce its own CBDC. This would be justified on grounds of national security, financial competitiveness, and sanctions enforcement. And once the infrastructure is in place, the temptation to use it for surveillance and control becomes overwhelming. This isn't because malevolent individuals govern, but because capabilities, once built, are invariably exploited throughout history. There are 5 systems that offer distinct risk profiles. 1. Physical precious metals, gold and silver, held in your possession. These are immune to digital surveillance, cannot be frozen, and carry no third-party risk. Drawbacks include storage burdens and liquidity friction. 2. Self-custody Bitcoin, offers censorship resistance, is permissionless, and has a hard supply cap. It is pseudonymous, not anonymous, and requires technical proficiency while also facing regulatory uncertainty. 3. Productive assets with real utility. Examples include agricultural land, water rights, and businesses that produce essential goods, regardless of currency stability. Disadvantages include illiquidity, management burdens, and confiscation risk. 4. Skills and tools. Knowledge that retains value when systems fail, such as how to grow food, purify water, repair equipment, or provide medical care. The principal cost is time investment, and skills cannot be stored or easily sold. Ooh. Community and relationships. Networks of people capable of bartering, trading, and cooperating when formal systems break down. This requires building trust before a crisis occurs. Notice what's absent from this list: foreign fiat currencies. This is because, as those who comment on these videos already understand, when major Western currencies collapse, they tend to do so synchronously. This isn't like the Weimar era, where one could flee to dollars. This is 2026, where every major currency is fiat, every central bank coordinates policy, and every system is interconnected through dollar dominance and swift integration. The Swiss franc might be the last to fall, and the Singapore dollar might be more prudently managed. But when confidence erodes, the cascade is synchronized. Therefore, the lesson is to diversify across these 5 categories. Utilize CBDCs for routine transactions where convenience outweighs privacy concerns. Maintain self-custody crypto for cross-border transactions and censorship resistance. Hold physical metals for long-term wealth preservation outside any digital infrastructure. Invest in productive assets that generate necessities. Develop skills that remain valuable when systems fail. And cultivate community before it becomes essential. The question is not whether digital currencies will proliferate. They are already here. The real question is whether they will be designed with privacy protections and limited programmability, or if they will evolve into comprehensive surveillance mechanisms. This outcome depends on whether populations grasp what is at stake before these systems achieve widespread adoption and institutional entrenchment. If you realize that the next 5 years will determine whether you can still buy bread without government approval, subscribe to this channel. This is the Independent Financial Historian. I unveil the blueprints before they are constructed and conduct autopsies after they collapse. It's free, unlike financial privacy, in a system designed to monitor every transaction. Drop a helicopter emoji in the comments if you are already diversifying away from purely digital systems, and tell me what you want me to investigate next. I read every single comment. The only lingering question is whether you will spot the trap before it closes, or if you will be left wondering why your money stopped working when you tried to buy groceries. The infrastructure is being created right now. in Switzerland at the BIS, in Brussels at the ECB, in Beijing with the digital yuan, and in Washington through executive orders and Federal Reserve research. The Canadian truckers learned the hard lesson. Digital money can be weaponized with a single keystroke. The Nigerians learned that populations will choose chaos over surveilled systems.